Morning, this is Professor Minton, and what you're looking at here is the Minton Media Moguls trial balance and chart of accounts. And I think what I did on the chart of accounts, I assigned the numbers to each one of these accounts. And when it came down to things like the um, customers themselves, I gave those numbers as well for subsidiary ledger purposes. Subsidiary ledgers, as you may or may not remember, those actually fold, they all fold into the 120 account, but we have to know who owes us what. And the same thing, of course, would be true for accounts payable. We need to know to whom we owe a particular bill. And so we have to have some way of distinguishing that. Now, with QuickBooks, what they do is they automatically do it by customer and as opposed to doing it by number, although they may have numbers working in the background. I don't really know whether they have a numerics working in the background or they're just doing it all by name. But either way, doesn't really matter. Of course, as you think about expansion of your enterprise over time, if you are using numbers, it's a lot easier to do those expansions than if you're looking just at names. For example, you could have 15 different types of screwdrivers. So it's just easier when you apply a number to something as opposed to applying a name, and it allows you for expansion um, that you might not have so easily with just assigning names to things. All right. And just doing a bit of a recap here, this is the what we call the opening entry. Now, it shows up here as the top as trial balance and chart of accounts. Now, you'll notice that as I work my way down through here, you do not see any expenses, nor do you see any revenue. There's a reason for that, because at the end of the last month, we closed all of those accounts out. They eventually wound up as part of retained earnings or equity of some sort. And so that's the reason that on this trial balance, because everything's closed out, all the temporary accounts are closed out. And you notice the same thing is true for withdrawals. There are no owner's withdrawals. Because if you'll remember, when we close accounts, we kind of do it in a specific order. Now, you could close your revenue and your expense accounts all in one entry, but typically I just like to use the old method where we close all of the revenue accounts to income summary. We then turn around, close all the expense accounts to income summary. Then we close the income summary itself to capital or equity. And then after that, we would close the withdrawals account or dividends account. If you were working with a corporation, you would close those dividends into the equity itself. In other words, they're going to serve as a reduction of equity or a reduction of capital. Okay, so again, we're going to come down to a balance in the trial balance, and it just ensures the mathematical integrity of all of our debits and credits. And of course, it does not mean that that's the way it's going to appear on the balance sheet. I'm going to come back over here if I can find it. Here is the home of this particular group of classes, okay? And I just picked this one at random. But if I come down to reports and I go to standard reports, and let's go to the balance sheet, and we have to come up here and adjust the dates because with QuickBooks, the dates automatically go to the current date. So from whatever we started with to this particular date that we're at today. In this case, we're doing 5 to 2026. Okay. But I don't want to see that. What I really want to see is I want to see just the February the 28th date. And so I have to adjust both of those back to February the 28th. And as for the balance sheet, and when I do, you notice that again, that total for assets is different than you saw over there on the trial balance, which was 824,125. And again, the difference is that on the trial balance, if it's a credit, it shows up on the credit side. On the balance sheet, however, we take into consideration a reduction here for all of our accumulated the depreciation accounts. And of course, if we had one, we would have a contra asset as well sitting out there for accounts receivable. And we would call that the allowance for doubtful accounts or bad debts or whatever, because there's several different names that people refer to that allowance as. But anyway, it would wind up reducing that amount on the debit side for all of these contra asset credits. And so that's the reason that you can't really look at the trial balance and say, okay, why don't we see the same thing on the balance sheet? Those are two different animals, right? Okay. So the next thing that we want to do here in this video is to just again appreciate what we're trying to do with the trial balance. And what we're really saying here is that this is our opening entry. Now, it's a fairly complex opening entry, and we had to do a lot of things in order to get to this point. So one of them, for example, was that we had to look at the note payable current of each one of these loans. And the reason we had to do that is because we split notes payable into the current side and into the long-term side. Now, I didn't make any kind of an allowance at this point for present value. And of course, in today's balance sheets and financial statements, we always look at the concept of present value, recognizing that, a dollar today is not worth the same as a dollar tomorrow, that kind of thing. But that's well beyond the focus of this class. However, this is not beyond the focus because what we really want to do is be able is to understand, if you will, that when you're into getting loans from banks and so forth, they may want something that shows them the current ratio. And if you're not segregating the notes payable current from the notes payable non-current or long-term, then you're unable to get to that ratio. So that's the main reason that I have looked at these and said, okay, what is the non-current versus the current side? Okay, so if I come back over um, to the amortization schedules that we prepared earlier, see if I can get up here to the top of one of them. It doesn't really matter which one that we're looking at, but I'll just go to the very beginning over here when we're talking about our buildings, okay? And so what I'm looking at is I'm looking at 12 months worth of principal reduction. So these are the principal amounts that we're paying each month. And you notice that they always go up a little bit while the interest value is dropping a little bit. And of course, the ending balance is being reduced by principal that we're paying that particular month. And so what I want to do here today is I want to show you how we get to an amortization schedule. I think I've probably done this in other videos, but I'm going to do it very quickly in this one. If you notice, if you go to Exhibit 1, which deals with all of the entries that we have, what we saw was that the very first entry was the purchase of a new delivery truck. And that delivery truck was basically used for going out and changing billboards and that sort of thing. And so in this particular case, just kind of running through the remembrance of the numbers, we had an original cost of $71,500 for this 3,500 truck, and we put down 11,500. So in terms of the amortization of that new truck over, I think it's 84 months, what we started with then was 60,000. So that was our beginning balance. And notice without any kind of payment that it stays at 60,000. So here's what I want to do. I want to kind of show you here, and I'm going to be a little bit more specific with this one than I was maybe in prior videos. So I'm going to take this and I'm going to undo the um, the shoot, come on, Randy. I'm going to undo the merge and center feature, basically. But I'm going to go ahead and merge and center just this one little piece here. And then over here, what I'm going to do is I'm going to put in a number for the interest rate. Okay. And as I recall, the interest rate on this particular one was 6%. Now, since I'm doing these on a monthly basis, there are two ways that I can go relative to the interest rate. And if this were, a complex interest rate like 4% or something like that, and I was dividing it by 12 months, then I get kind of a funky number. And so I would do it differently if I had that situation. But in this case, it's very straightforward. With a 6% interest rate, that's half of 12. And if you had a 12% interest rate, it'd be 1% per month. In this case, since we only have a 6-month, a 6% rate, I should say, then I can look at that just simply as a number of 0.005. Now, why do I want to look at it strictly as a number? Because I'm just going to reference this field. I'm not going to say 0.005. And the reason is, in this case, it probably would make no difference at all. But if you were doing a what if analysis and you were trying to figure out, for example, what would happen if I were to get a little bit cheaper interest rate by financing it for a shorter period of time, if I do this, if I set this up properly, then I don't have to worry about going through and changing all of my entries below because I'm going to refer to this particular cell in Excel and make sure that it's always going to that cell in order to make the computation. So the way that this first one would work here on the interest rate and would be that I would simply look at this particular number and I would multiply it by whatever's in this cell. And as I go down forward, I'm going to make sure that it's always referencing this cell. Because if I'm not careful, I would wind up having to, eh, by relative referencing, it would go down here to payment and then give me a crazy thing. Okay. By showing this as an absolute reference that it's going to refer to every single time, I don't have that issue. So in this case, what I'm going to do is I'm going to say that it's equal to, I'm just going to point to the cell because whatever's in this cell, as it goes down, remember that beginning balance um, will eventually work its way over to the ending balance, which will come back to the beginning balance for the next month. So as long as I just reference this cell and as I pull things down in Excel, it's going to go down to the next cell and the next cell and the next cell and so forth. So so this becomes a relative reference while this one is an absolute reference. So the interest rate in this case, 0.005, the times whatever's in this cell, F4 it. Because when I F4 it, notice what happens. It may be hard to see here, but as a matter of fact, I think, let me see if I can blow this up a little bit for you. It's not going to let me. Anyway, you would have this as an absolute reference. So when I hit enter now, it's 300. And so listen, if it was 1%, it'd be 600. So if it's half that, in this case, 0.005, 300 makes sense, right? Okay. Now what we have to do is we have to figure out what the payment is. And I'm going to put the payment right here. And okay, so I'm going to say that it's equal to PMT. That's what Excel likes for payment. And open parentheses. And it wants to know the rate. So I can point to the rate again, and I'm going to F4 it again so that it doesn't ever change that number, whatever's in the field. So if I change it to, to 0.0025, for example, it automatically will change everything below. But the payment here is going to be equal to the rate, comma, the number of periods, in this case, 84. And I could put those up here too someplace if I wanted to. Matter of fact, I think I will. So let me back out of this just for a second and go ahead and finish this up. I'm going to put up here the number of payments is 84. And I probably, if I were doing this in a more formalized setting, what I should do is probably identify that somehow so that people are not wondering what the 84 means. And let's see if I need something else over here. No, I don't think so. Okay, so equal PMT for payment. And understand as I go through this that the the payment in this case, all I'm looking at is the interest and the principal. But in the real world, you're going to have loan origination fees that are part of the payment, and other things, maybe replacement of the vehicle if it gets totaled or whatever. So that's probably going to be a bigger number, but you would just have, if you had that situation over here where you have interest next to that, you would have whatever those things were. You could have loan origination or whatever you wanted to put in there. Now the rate again is going to be, I'm going to point to that cell because I want to be able to change the number in that cell and have it still work. So it's going to be that cell, okay? And I'm going to F4 it times the beginning balance. I'm sorry. I'm completely screwed up here. Payment, comma, the number of periods. I'm going to point to this cell. And again, I'm going to F4 that. Sorry about that. I got kind of reverting back to where I was. And the present value of the loan is going to be this cell. Okay? And so I'm going to, just for the heck of it, I'm going to go ahead and give that an absolute value as well. And this is your payment. Now you notice that it shows up as a negative number. Well, to be able to use this effectively, I think, or more effectively, I'm going to make it a positive number. So I'm just going to come up here to do that, and I'm going to multiply it by -1. And when I hit enter, it took the brackets off of it, so it's now a positive number. And I could start out here at the beginning of the string with ABS for absolute value, and it would give me the same kind of a thing, give me a positive number here. But I want to be able to, if this changes with the what if analysis, I want to be able to continue to work through everything based upon that particular change. So what did I do? Well, again, the payment is equal to the interest rate up here. And I've treated it as an absolute just in case we decide that we're going to try to get a reduction of the interest rate. Okay. And then the next thing was the number of periods, and the number of periods in this case was 84, but I made it an absolute reference as well, because if I change it to 72 months, I don't want to have to go through and make any changes in my payment. It's going to pop up automatically, and then all of the entries that work off of that payment will adjust themselves as we go through. But probably I may even show you how that actually works. Okay, now what we need to do is calculate the ending balance and the principal. Now the principal is going to be net of the interest, and so I'll take this number here, whatever's in this field, and I'll subtract the interest, and that'll give us the principal. And the principal is the only thing that is reducing this beginning balance. So it's equal to, excuse me, this number. And again, I'm going to make it an absolute reference so that I don't have to, so that I can make changes to it anytime I want to. Minus the interest. Now, I don't make that an absolute reference because it's going to change going down through here. Okay. It gives us 576.51 and an ending balance of this number. Now, again, I'm going to just, because I don't necessarily believe that every time I make an entry, I get it done right. But at least for this particular one, if I take 576.51 and add it to 300, I get the 876.51. So I know that the entry, at least to this point, is correct. We'll see if it's correct going forward. So the beginning balance then becomes the ending balance of the previous month. And so now I should be able to, I hope, just come down here and bring these two down. Now, I'll tell you what I'm looking for. Again, I'm looking for this number in the interest column to drop a little bit. And I'm looking for this number in the principal column to increase a little bit. And I have both of those situations. I went from 576 to 579. I should see a reduction here of the ending balance. So now I think I've done this correctly. I can grab this entire group, and I'm just going to bring them down a few. Because what I want to see is I want to make sure that that holds true going forward. So my principal, it keeps rising, my interest keeps dropping. So that makes sense. And so what I'm going to do now is just grab this and drag it all the way down through the end of the 84 months. And when I do that, you notice that the very last principal balance that I have is zero. That's correct. Because if I have made religiously or consistently, if I have made the same entry over and over and over again and paid that bill every month through the 84 months of the term, I don't owe it on the 85th month and it shows up as zero. That's the amount that I owe at this point. Okay, so that's how we get to the amortization schedule. And I've got 22 minutes in here. So what I'm going to do is I'm going to shut this down at this point. And just remember that if I were to take now let me just do one last thing. If I were to take the principal 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. This is the amount that's due over the next 12 months. So that would be the current portion. Okay. Everything below that would be due in the out years. So I need to make this, when I put the entry in for this particular one, I need to make sure that I am separating the short-term or current notes payable from the long-term or non-current notes payable. So I'll have two numbers for the notes payable, and um, and they will equal at the end of the day on the other side um, a balance. Okay, that and again, I think if you were to look at the actual entry that we're going to be making, we would have 71,500 as the new truck. Whatever the total of this is would be the note payable on the credit side for the current, and then whatever the total of 60,000 minus these 12 would be, that's your note payable long term, okay, in the out years. And the difference, of course, is going to be your equity. It's going to be the equity that you have in the truck. So you bought a truck for 71.5, you only owe 60,000 on it. Um, and you would have a difference there of 11.5. And that $11,500 difference, of course, is your equity. All right, so I'm going to close this one off and we'll have a brief quiz over it. And then this is just to make sure that you got everything that I have gone through. And then we'll go on to the next section.